You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, the monthly update series for June 2013. And on today's show, the life insurance update with impaired risk expert Jessica Lopez.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. With me today, not only impaired risk extraordinaire expert Jessica Lopez, but she also is Major League reporter. Hey, how you doing?
Hey there, Steve.
Hey, and we're going to do something weird. Last month, on our life insurance update, we did history, a little history lesson.
Right.
And I have
Very
to tell you,
informative.
was that surprising on the numbers we had on
Oh,
that?
absolutely. They're huge.
I was really surprised that people said, Steve, I really wanted to know what was the genesis behind, like reserving. What was a term? When did whole life start? I mean, I was surprised how people really wanted to know it. We're going to kind of take a page out of that. I'm not doing history today, but many of you know that I'm a major blogger online. And we just started blogging. We've been having our show like One for the Money, which is our consumer show. We've been blogging and answering questions by consumers. Now, I have to admit, I'm the guilty one here. I keep thinking this is what they want to talk about, and then I read these questions that I started responding to. And in the last 30 days, I've responded to 300 consumer inquiries.
Wow.
And what they're asking, I'm starting to think this is what they want to know about.
Right.
Remember, these are coming from people, regular, everyday Joe lunch bucket, right? So, Jesse, when we're looking at these consumer questions, didn't you think that was a little odd that we were getting, these are the kind of questions? Because I would not have thought this is what they want to know about.
Right. And, it really just kind of reminds us that we need to maybe take a step back and think about what their needs are, what their curiosities are, because we can sit here from the wholesale brokerage side of things and, market to this or that and the other thing. But really what's going to captivate them, what's going to grab their attention, what's the information out there that they're seeking and they can't seem to easily find somewhere else. I think it's very important, and it's great that you were able to kind of come across this with some of the industry blogs and social media things that you've been doing. Some of the common questions that we noticed were, does whole life insurance have cash value?
And I thought to myself, how rudimentary is this? This is very simple. Yes, it does. And when I answered this, I started talking about, well, remember now, if you're buying whole life insurance for a death benefit or indemnification, it already has inside a base policy, it has cash values. If you're reusing this for a retirement plan, you could actually use a whole life term rider with the base contract and a thing called the paid up additions rider to really generate even more cash if supplemental retirement was your goal. So when I'm looking at cash value, and I made an allusion in my answer, not only does whole life have cash value, but there's other contracts in the universal life arena that also have the same thing.
Now, why would somebody entertain a term rider?
Well, because what we're trying to do, if you're looking for cash on cash, if you're looking for the maximum use of accumulation and indemnification or the death benefit isn't really that big a deal, well, then that's the way to maximize these contracts. And think about this. If you're showing an index universal life contract at 5.5 at the low end, because most people use the S&P 20-year, 2 tranches that show that the S&P 100% probability was 5.5% over those 20-year periods, you get a good whole life contract using a maximum term rider and a huge paid up additions rider that lets the pass-through go to the cash value column. That can make those numbers almost right there with indexing at the lower level of quoting. So I kind of like it. And remember, there are people that say, indexing, I'm not really sure about.
Kind of confusing.
I like a little bit more on the guarantees, which the whole life does get at the lower index quote that I just gave at 5.5. People like that.
Okay.
Yeah.
Another common question that we came across is, how does a loan on a life insurance policy actually work?
Well, first of all, I thought about this because I almost went into producer mode. I started answering the question the way it was by the time I got done, it was like a white paper. And I said, I can't do that. It's a consumer wants to know this. Consumers don't know the charges on life insurance when they're borrowing, and especially if you're thinking about doing supplemental income, you have to figure out, hey, there's some charges to be had here, and does it matter? It could matter big. On whole life, we use spread loans and direct recognition loans. In my opinion, direct recognition loans are the most punitive and anti-consumer loans for a policy, so I'm not really into it. But there are some good spread loans. I'm thinking of like Mass Mutual is one of the ones I would think about. On the other side, on Universal Life, and just as a comment here for our producer audience, current company assumption Universal Life is a platform. On that platform, you could have indexing. You could have sub-accounts in variable, or you could stay with current assumption interest rates. It's the same platform, it's just using different crediting methods. Well, Universal Life has zero net cost loans, spread loans, right? Wash loans. And with indexing, you have participating loans. And all those spreads actually charge the consumer. And what are those numbers? Depending upon how the company charges and credits at the first or the end of the year, those numbers could actually be higher or lower. It makes a difference to look at this, especially if you're zeroing in on supplemental income for retirement.
Right. Now, if I'm sitting here wondering what I should do, what I should go with, and hopefully my advisor as a consumer would know the difference between these loans. So what would the primary difference be between, a wash loan and a participating?
Well, let's just take it. Zero net cost loans, and remember, I'm doing a generic because everybody's contract is going to be different, but this is pretty true across the board.
Generally.
A zero net cost loan on a Universal Life platform is going to be the charging and crediting of the same rate 31 days apart. So there's not going to be any small accrual charge there. A wash loan is the charging and crediting of the same rate, charging at the beginning, crediting at the end, and there is a small accrual charge, even though people say, well, there's no cost here, it's a wash loan. Well, technically, over the life of the loans during distribution, there could be a small accrual charge because the timing is different. So the charging and crediting. A spread loan is the charging and crediting of a different rate at the first and the end of the year. And participation loan is what happens if my performance in the index is greater than my loan charge? I make money for loaning it to myself.
Wow.
When we come back from the break, we're going to continue our monthly life insurance update for June 2013 with Jessica Lopez. Hey, and don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
Living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Jessica Lopez. And remember, you can order today's material and any of these questions and answers that I've already done. Just click on, go out to our site at www.thebiz.tv and say, Steve, I want those questions and those consumer answers that you gave. I really liked it. And remember, while you're out there, go ahead and click on the background technician icon for a 30-day free trial, absolutely free. I've been using it for 22 of my 30 years. It's the best for needs analysis and client education materials, and it addresses almost every financial planning scenario. And just a heads up, before moving forward with anything that we talk about on the show, always check in with your tax advisor and your legal counsel, as well as, if you're FINRA licensed, your broker-dealer compliance department. Well, we're answering questions and talking about what do consumers ask me on the online sites that we actually troll, and we're just going through some of them. You have some more.
Absolutely. And one of the next common questions would be, what do life insurance policies cover? Now that kind of seems like a broad question, but it's a very good question because life insurance does serve multiple purposes, and this is something that consumers are maybe hearing a little bit about, kind of confused about, and
Right.
this is something that you've been addressing quite
I do, and I always ask the consumer when I get a question like this, I go, are we doing indemnification? Are we doing income? Or are we doing inheritance? Notice I'm using 3 I's. I call that the macro category of financial planning. I'm trying to get it so I can block it out and make it simple to understand. Indemnification, of course, is coverage, protection. It could be single life, it could be second to die or survivorship. Income could be taxable, tax deferred, or tax free, depending on how it's set up. And keep in mind, people go, well, why would I want taxable, Steve? Well, there's sometimes when a modified endowment contract, based on the client's actually blended tax bracket, I might actually look at that as a play. Because sometimes the actual annuitization of a contract hasn't graduated to the 2001 CSO, and those rates are actually higher than we're doing today. And sometimes that play's willing to do it. And of course, inheritance, sometimes I want to be able to pay estate taxes, or even better now, that people say, well, Steve, the unified credit's so high, why would I need to pay it? Well, then check it out. Your state of domicile, your resident state. Remember, that state is still charging you when you transfer estate taxes, and they're a lot lower than the unified federal credit. So you need to look at that. But other people want to do legacies for their children,
Right.
legacies for their grandchildren. Oh, legacies for the charity that they love. See, there's reasons to do it. So those are the 3: indemnification, income, and inheritance.
Very nice. Now, why use an irrevocable trust?
Well, I'm using an irrevocable trust, and 90% of Americans that use this are using it for one reason and one singular reason only. There are other reasons, but this is the main one. They want to keep it up and out of their estate. Because if that death benefit came into their estate, or in some business scenarios, I have to say, some business scenarios, it could actually not only cause a taxable event, but you may have to pay the AMT, the alternative minimum tax. Again, I don't want to get into that today. That's a rare situation, but it's there. But for most people, people say, if I add the death benefit into my estate, and I always go, is your estate greater than the federal unified credit or your resident state? If it's greater than that, then I need an ILET, or an irrevocable life insurance trust, to keep it up and out of my estate, because I don't want to pay taxes on a death benefit.
Perfect.
I want my beneficiaries to get it.
Interesting. Now, this is another pretty general question that's coming up pretty frequently. Which is the best life insurance to buy?
Now, I laugh at this. I laugh at this. As I just said before, there are carriers that are excellent in indemnification.
Right.
There are carriers that are great in income. They're not the same. There are carriers that are great in inheritance. None of these macro categories of financial planning, there's not one carrier that plays in the top 3 to 5. It's amazing.
So are you suggesting that we might have multiple policies to take care
You're
of?
going to have to, and remember, I haven't got to underwriting yet. So then when I get out of the category of why I'm buying the insurance,
Sure.
then I have to look at the age, the health, the smoking status. Do I have financial justification? Do I have other issues that are going to touch underwriting, like recreational, vocational? I need to know those things. So every carrier, if somebody came to me and said, Steve, what's the best company for diabetes? Well, I'd have to say these 3.
Right.
It wouldn't be these other 4.
And then again, diabetes, and what's the purpose of insurance?
Right. So the combination is, once I hear the underwriting issues and I'm trying to do the planning issues, is this indemnification? Is this income? Is this inheritance? Then I'm going to make a call by coming to the best spreadsheets, and then we create our own grid to say, in your situation, that's the best company.
Very nice. Now, what happens if you just stop paying your life insurance premium?
Well, hopefully you got a lot of cash in there to pay those premiums for you. But let's say just on the raw data, I bought a term policy, doesn't have cash value. And if I stop paying it and I'm past the reinstatement period, because they'll give you a little grace here, about a 30-day, most states, there's a few that give a little longer, they give you a 30-day grace period to pick that premium up. But if you don't pay a term contract on time and you're past the reinstatement period, you're going to lapse your coverage.
That's scary.
Now that's scary, especially if you bought it for coverage, you need to continue it. And remember, if you say, well, I missed my time, well, you still may be in the reinstatement period, so not all is lost.
Right.
Now, one other thing, keep in mind, some cash values are strong enough that you may not have to pay for a couple years. You said, man, I'm really tight for money right now. Well, let's go and order an in-force ledger, see what those numbers are, and then we'll say, oh, you could duck out a few months here until you get back on your feet in your budget.
That sounds like the way to go. Now, what life insurance is best for me? So this is another question that comes in. What's the best type of insurance? What is insurance for? What's the insurance that's best out there for me?
Well, think about this, and I've lived to see this day now. This is strange. I have a carrier right now that owns the female market on every spreadsheet I've looked at, non-risk. In other words, they have to be standard or above. This is such a revolution because we're saying, well, who's good in diabetes? Who's good in, certain other diseases, certain categories? Now we're doing it by gender and by how long they're going to live, and everybody's standard and above. I've lived to see the day. Well, that's our show for today. Remember, you can follow me on Twitter, Facebook, LinkedIn, and email me at steve@thebiz.tv. That's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.